In this week's video, we'll review the latest charts and data to help us understand the two most important destinations for investors. Video is designed so you can use the pause button on your video player. 100% of this week's video was recorded on Friday. This segment is being recorded after the close. Our 4 questions are still relevant, and you may remember from last week's video, covered every one of these indices or ETFs or ratios over here and showed that they were still concerning from a trend perspective. S&P was down 3.34% for the week. Every single one of these positions was down. XLP divided by SPY was up 1.52%. That's a defensive position moving in the wrong direction for the market. And the US dollar as of Thursday's close was up as well. Bond prices are falling, interest rates are rising. Had an ugly breath day on Wednesday. Trend in interest rates is clearly up. This is Friday's close, the 10-year yield. And nothing particularly special about the counter-trend move on Friday, a 74% up day. We covered these concepts in detail last week. If the market expected that the Fed was about to pivot, if the market expected that inflation was about to plummet, if the market expected that interest rates were about to peak, really, none of this aligns with that, nor did the charts last week. That can change at any time, but it hasn't changed yet. Foreseeing the term FOMO during Friday's session doesn't align with sentiment that screams major low. Before we talk about the destinations, let's talk about the 2 primary drivers. Driver number 1, Fed policy. Driver number 2, the economy. Everything that follows needs to be understood in the context of the 1970s. In 1974, the inflation rate was 12.3%. It dropped significantly to 6.9%. The Fed started to cut rates. Unfortunately, this number here, 12.3%, ended up moving higher years later, 12.5% in 1980. And look at interest rates here, 8%. To try to tackle this problem here, 18%. These are the mistakes of the 1970s that the present-day Fed wants to avoid. All of that aligns well with the message that was delivered at Jackson Hole on August 26th by Powell. The first lesson is that central banks can and should take responsibility for delivering low and stable inflation. The second lesson is that the public's expectations about future inflation can play an important role. Third lesson, we must keep at it until the job is done. They want to avoid this type of outcome where inflation becomes entrenched. On Friday, October 21st, before the market opened, the Wall Street Journal published a story caused the futures to reverse somewhere in the order of 74 points almost immediately. Let's start with this and we'll come back to it. The October 21st Wall Street Journal story that ironically started a stock rally was meant to prepare the markets for A, this week's Fed statement, and B, Powell's press conference. I think it's also fair to add a C, which would be the next Fed meeting, the December meeting of this year. Here's some of the more important text from that October 21st story. Additional important points. Messages given to the markets on October 21st. If we were posed with a hypothetical question, did the big money in the stock market read this article and did they take it to heart? From my perspective and from the market's perspective, the answer is absolutely positively yes. The bond market never bought into the Fed pivot theory. This is October 24th. When the market rallied off the June low, we had a risk-on type appetite and interest rates came down. It was a logical move. We really haven't had that at all since the rally that started earlier in October. And even on October 22nd, after reviewing a wide variety of asset classes on a wide variety of charts and time frames, it was clear that current market leadership and market laggards align with the thought that the bond market has lost confidence that inflation will naturally come down, which is another way of saying the bond market and asset class behavior had not really bought into the theory that the Fed was about to pivot in a dovish manner. That was not the message in the original story either. And if you watched last week's video, I'm guessing numerous times during the video we said a chart like this doesn't align with the theory that the Fed is about to pivot in a friendly way. And we showed countless charts like this that were emblematic of this concept here and this concept here. And a wide variety of charts, the charts that we covered in detail last week, told us that the market was skeptical that there was going to be a sustained rally after the Fed meeting. Markets aren't closed on Friday, 1:50 p.m. Eastern Time. Hasn't been a good week for stocks thus far. S&P down 4.67% for the week. NASDAQ 100 down 7.64%. The NASDAQ Composite, the broader NASDAQ Composite, down 7.29%. Just as it was important for us to read the October 21st article in the Wall Street Journal very, very closely to discern the intended Fed message, we're really not interested in opinions about what happened at this week's Fed meeting. Let's look at the specific statements from the Fed chairman, which is another form of trading the chart in front of you. Let's look at the facts. Powell opened with a statement that was very, very similar to the statement made at Jackson Hole. Price stability is the responsibility of the Federal Reserve. It's the bedrock of our economy. Without price stability, the economy does not work for anyone. It's a pretty strong statement. Let's get into this concept that this story from October 21st was meant to prepare the markets for the statement that was released this week and Powell's press conference. And notice, Powell makes a reference specifically to the statement. And this is initially what the market interpreted as bullish, that the Fed was going to take into account the tightening that's already been done and the lags relative to raising rates and the economic impact that follows. This concept here and this concept here are really why this article was published on October 21st. The Fed does believe that it's prudent to slow down. And that takes us to the key text in this October 21st story. If officials are entertaining a half-point raise in December, they would want to prepare investors for that decision without prompting another sustained rally. And that really gets to Powell's press conference. Now, if you've watched a lot of these press conferences as we have, it was extremely clear that Powell was very well rehearsed for this press conference. Very few ums and stuttering and pauses. He knew exactly what he wanted to say, and he knew exactly how he wanted to say it. He made it a point to say that the labor market remains extremely tight, and that showed up in Friday's labor report. The labor market continues to be out of balance, and we really haven't seen any meaningful change in terms of people coming into the workforce to take pressure off wages. He made it very clear that inflation is still too high. Recent reports have come in higher than expected, and price pressures remain. All of these direct quotes from Powell taken directly from the transcript of the press conference. Reducing inflation will likely require a sustained period of below-trend growth and some softening of labor market conditions. Notice the word require here. It basically says if the economy starts to weaken, we should not expect the Fed to immediately become dovish. That's what they want to happen. They're trying to hit wage pressure. Restoring price stability is essential. Notice, they're not saying avoiding economic weakness is essential. Because if they can restore price stability in the long run, everyone will be better off. This sentence here is about as scripted can be. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. That's the third lesson from Jackson Hole, which is that we must keep at it until the job is done. Why does the Fed make so many public statements? Why is the Fed basically planting messages in the Wall Street Journal? The Wall Street Journal had a follow-up story that made the same points. Here's one additional point, and we're quoting from the Wall Street Journal. The Fed's policies work through the financial markets. What does that mean? That means typically when the markets shift to full-bore risk on in this environment, very, very similar to the June low here, and here, that the Fed is thinking that interest rates are going to come down, inflation is going to be tamed, and the Fed's going to back off. And hence, guess what happens? Bonds rally. And guess what happens? Financial conditions loosen. Interest rates come down. The Fed doesn't control financial conditions directly. Straight from the Wall Street Journal, the Fed's policies work through the financial markets. This is a way of explaining why they communicate so frequently. So relatively early on, he specifically references the language in the statement. And then he purposely comes back to say, I want to talk about the statement language. I want to give it some context. Why? Because the Fed's policies work through financial markets, and we don't want everybody to go out and start buying bonds and have interest rates come down, financial conditions loosen, and undo all of the good work that we've done since we started raising rates and started jawboning a long, long time ago about raising rates. They don't want any of that to happen because they need to tackle inflation. So this is all done according to a plan. They knew what they were going to put in the statement, and they knew how they were going to handle that to make sure that the markets didn't interpret it as the Fed being soft on inflation. Where did that come from? The original Wall Street Journal article, October 21st. First, do they raise rates by a smaller half-point increment in December? And if so, how do they explain to the public that they aren't backing down in their fight to prevent inflation? 3 words, the press conference. So this is where he takes the statement language and gives it some context. Notice here, he says you can think about our tightening program as really addressing 3 questions. Again, very well planned out in advance. Number 1, how fast do we raise rates? 75 basis points or 50 basis points? Second, how high do we eventually go? What's the terminal rate for the federal funds rate? What's the end destination? Hence the title of the video. And once we get there, how long do we stay there? How long do we remain at a restrictive level? How long does it take before we really pivot? What do I mean by really pivot? Traditionally, a Fed pivot is when you go from restrictive policy where you're raising rates. The pivot is when you decide to cut rates. A half pivot might be what's happening now, cut at a slower rate, but they're trying to make sure that it's not interpreted as a dovish pivot and a Fed that's soft on inflation. So to drive it home, don't take this as dovish. Powell says ongoing rate increases will be appropriate. When he was speaking, he said the last labor report that we got was strong. Friday's report was strong as well. And he said particularly the CPI report. And right here, this is how they handled this issue. How do they explain to the public that they aren't backing down in their fight to prevent inflation? He says the labor market and inflation suggest to me that we may ultimately move to higher levels. The destination will be higher. The terminal rate will be higher. Is that a theory? Again, straight from the original Wall Street Journal article. If officials are entertaining a half-point rate rise in December, which they are, they would want to prepare investors for that decision in the weeks after their November meeting without prompting another sustained stock market rally or bond market rally. We don't want financial conditions to loosen. How might they do that? They telegraphed one possible solution would be for Fed officials to approve a half-point increase in December while using their new economic projections to show that they might lift rates somewhat higher in 2023 than they originally projected. There it is right there. It suggests to me that we may ultimately move to higher levels. So they had the original article on October 21st, and then there was a follow-up to make sure the message was delivered. But the debate over the speed of increases could obscure a more important point around how high rates ultimately rise. October 21st, we'll offset it by saying rates will go higher. October 30th, we'll offset it by saying rates will go higher. Extremely well telegraphed, well in advance, and delivered right here. Press conference. To be clear. What does to be clear mean? To be clear means I want to make this point, and I thought about it before I stepped up to this podium, and it's an important point. Let me say again, The question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restricted. Don't focus on number one, shift your focus market to number two and number three. And they went out of their way to specifically deal with some of the concerns or criticisms coming from market participants. Number one, I don't think we've over-tightened. He basically says it's very difficult to make the case that we're too tight now, given that inflation still runs well above the federal funds rate. It's a rule of thumb from history that in order to squash inflation, the federal funds rate eventually has to get higher than the inflation rate. That's not the case today. And when he says something like, remember, though, that's his way of driving home an important point. There's a need for ongoing rate increases. Don't get stuck on the fact that we might raise by 50 basis points. We have some ground left to cover, and cover it we will. It's a very definitive and firm statement. And here's where he talks specifically about what he mentioned, Jackson Hole, the lessons from the 1970s and early 80s. He's saying we're now 18 months into this thing. And he's basically saying if we mess around and pause, it's possible that inflation expectations will become entrenched. The thing we need to do from a risk management standpoint is to use our tools forcefully, but thoughtfully, and get inflation under control. Get it down to 2%, get it behind us. That's what we really need to do. We don't need to worry about the economy. We don't need to worry about other countries. We don't need to worry about something blowing up as our primary issue here. That is important. That's where the thoughtfully comes in. And we're strongly committed to doing it. Strongly committed. And he acknowledges, is it possible that we could over-tighten? One of the criticisms. He's saying we could always cut rates. If we go too tight, we can reverse course if we have to. But if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched and the cost, the employment cost in particular, will be much higher potentially. Meaning, if we deal with it now, the unemployment rate will have to go up to X. If we don't deal with it, the unemployment rate might eventually have to go much higher than X. We want to be sure that we don't make the mistake made in the 70s of either failing to tighten enough or loosening policy too soon. Failing to tighten enough or loosening policy too soon. 1975, 1976, 1977. Why did they start all this? Because they do believe, you can see the statement for that it's prudent to slow the pace of the hikes. Why? Something might blow up, and policy works with a lag. But that doesn't mean that we're getting soft on inflation. Once again, let me say this means this is an important point, one that's basically been rehearsed. It's very premature to be thinking about pausing, meaning pausing the rate hikes. It's very premature, in my view, to think about or to be talking about pausing. We shouldn't even be talking about it at this point. We have a ways to go. How do we back it down because we're respecting lags and that something might blow up? How do we do all this without prompting another sustained rally? And how do we do all this in a manner so the public doesn't think we're getting soft on inflation, allowing inflation expectations to become entrenched? Which is exactly what he talked about here, entrenched. So how do you do all that? You deal with the stepping down in the statement, and you deal with the other two concerns in the press conference. A lot of these quotes are in response to questions. And this is about how do you get inflation under control? What are you trying to target? Powell says a big channel is the labor market, and the labor market is very, very strong. Emphasized, again, very strong. Then he shifts gears to another concern. Households, their balance sheets, they have money in the bank. Strong spending power. Labor market strong, a lot of money in the bank. What does that do? It may take time. It may take resolve. It may take patience. And it's likely to. So he doesn't really even want to say may. Most likely, it's going to take resolve and patience to get inflation down. So they've already directly addressed two criticisms about their policy. Number one, you're over-tightening. And number two, that tightening is going to cause economic problems and something might blow up. Here's criticism number three. Again, addressed head-on, directly, in a succinct manner. What about the rest of the world? What about all the problems with currencies and foreign bond markets? He says, inflation's too high. The world's not going to be better off if we fail to bring inflation down. So he's basically saying we're not going to be doing anyone any favors if we're soft on inflation. So yes, we take that into account, but it's one of many factors. And notice they're dealing with the objections or criticisms head on. Why? So they can stay the course and deal with the primary problem, which is inflation, and avoid making the same mistakes that were made in the 70s. More Q&A here. What about this portion of the yield curve inverting? And you can read this story. Now, why is this underlined in green? Because this is probably the most bullish statement in the entire press conference. He's saying the inversion could be because the market expects the Fed to cut, which he's not endorsing, or because the market expects inflation to come down, which tells us to keep an open mind and be highly flexible. Because most likely, the Fed is going to talk tough, and then one day shift gears because the data allows them to do that. But they'll continue to talk tough until the data allows them to shift gears. Why? They don't want inflation expectations to become entrenched, which the October 21st article talked about. How do we avoid that? So historically, an inversion has preceded every U.S. recession since 1950, with only one false signal, the credit crunch and slowdown of 1967. Recessions tended to follow with a significant lag. So some market participants may be thinking, and rightly so, that this means that the Fed is getting closer to pivoting and risk assets are going to do well. And that absolutely positively may be the case. We should also understand that in the historical cases, and we covered them all last week in detail, the three major bear markets, 73, 74, 2000 to 2002, and the financial crisis, after the first sign of inversion, this segment of the yield curve, what happened in the stock market? Did it go up? No. The average additional loss in the S&P 500 after the first sign of inversion was approximately 45% in these three cases. This is also noteworthy. It's been a very, very difficult year, even for the market model. In this case, at the first sign of inversion, if you bought bonds, you absolutely killed it. Similar situation here. If you bought bonds at the first sign of inversion, bonds did extremely well. When yields are falling, bond prices are rising. Buying bonds in the inflation-induced 1973-74 bear market didn't work out nearly as well. The 10-year yield went up from the first sign of inversion until the market found a bottom on October 3rd, 1974. Meaning, the inflation-induced bear market, much more difficult in terms of finding places to offset losses or drawdowns on the equity side. You could do that with bonds in the past, and in a big way. TLT killed it in these bear markets. Bonds, not so in this case. So we'll take it day by day. Also noteworthy, during Friday's session, today when this is being recorded, the Dow was up 600 points and then eventually turned negative. This really aligns more with a bear market than it does a healthy bottoming process where we're in full bore risk on. So we have to keep an open mind. Even if the Fed is talking tough, they could flip very, very quickly if inflation improves. Came back again about over-tightening. We have a way to deal with over-tightening. Conceptually, the question from a reporter was along these lines. Since you're stepping down possibly the rate hikes from 75 basis points eventually to 50, either at the next meeting or the meeting after that, should we interpret that as the risks are more balanced now relative to over-tightening or being too soft? And his answer was, no, nothing's changed. What I'm trying to do is make sure that our message is clear. Again, scripted, very succinct, well thought out and telegraphed well in advance. Our message is clear, which is that we still have a ways to go. I've also said that we think the level of rates are going higher, and that's been the pattern, and he's implying that they could continue to rise over time. That our dot plot at the next meeting doesn't necessarily mean that's the peak. How do you prevent the markets from rallying? How do you prevent the markets from thinking that you're soft on inflation? How do you prevent financial conditions from loosening and making your job to combat inflation harder? This is how you do it. Powell, I have no sense that inflation is coming down. We're exactly where we were a year ago. So once again, emphasizing again. So I would also say it's premature to discuss pausing. It's not something we're thinking about. And it's not really a conversation to be had now. Shouldn't even be talking about it. We have a ways to go. And the last thing I'll say, what does that mean? That means I'm here to deliver a specific message, and I'm not going to stay here too long today, is that I would want people to understand our commitment to getting this done. Don't let inflation expectations become unanchored. We're committed. And we're committed to not making the mistake of not doing enough or the mistakes of withdrawing our strong policy and doing that too soon. What does that mean? We don't want to make this mistake right here. We will stay the course, which means people are going to be upset. We may not be very well liked, but we're going to stay the course until the job is done. This is really important here. All of this that we just covered, I control those messages, and that's my job. Again, I'm here to do something very, very specific, to control the message and deliver it in an unambiguous manner. Q&A here. Does Powell think it's going to be harder to achieve the golden soft landing? He's saying, yes, I think it's going to be harder. I would say the path, and that would be the path to a soft landing, a soft economic landing, has narrowed over the course of the last year. This is really important too. The point here is that inflation is job number one. No one knows whether there's going to be a recession. Our job is to restore price stability. Our job is not to worry about other countries at this point as our primary concern. Our job is not to worry about the stock market. Our primary job is not to worry about the economy and avoiding a recession. All of that's important, forcefully but thoughtfully, meaning all of those things are relevant, but they're not the primary objective here. Our job is to restore price stability, and that's what we're going to do. Also very relevant here, the press conference was shorter than it typically is. Hypothesis? He had delivered the message, and he really didn't want to overstay his welcome and have some type of misstep that would undo the message. There's a lot of conjecture that a reporter's question changed the message. These are, of course, opinions. I don't believe that at all. I believe this message has been well scripted in advance, and it was delivered exactly as it was scripted. This is the very end here. I just think that the inflation picture has become more and more challenging over the course of the year, without question. That means we have to have policy be more restrictive, and that narrows the path to a soft landing. We want to avoid a recession, is what he's saying here, but if we have a recession, it's just what we have to do. That narrows the path to a soft landing, I would say. Again, I have to make this point. And then, very succinct, thanks very much, and he walked off. I've delivered my message, it's time to go. I control those messages, and that's my job. I've done my job, it's time to leave. Can't emphasize this enough. The Fed is going to talk very, very tough until something moves in their favor. Maximum flexibility 100% of the time, understanding that the Fed can pivot at any time. We just haven't seen anything that says a pivot is imminent. Has the market been listening to the message that was delivered on October 21st, the message delivered by Powell in the press conference? The answer is yes. Rate expectations looking out to May of next year, higher really than they've ever been. Looking back 1 day, 1 week, 1 month, and it's not even close. 1 month ago, 0% probabilities for the band between 5.25% and 6%. Those percentages are much, much higher today, and they were higher at the close today than they were yesterday. Higher at the close today over here, significantly higher than they were a week ago. Thursday's close, 50-day moving averages, not really what we want to see if something's about to change. This is significant. Your leaders, this is a weekly chart, RSP equal weight S&P 500 divided by SPY. That looks pretty good on the weekly cloud. In isolation, doesn't look good at all. That's not a good sign. The longer this remains, the more concerning it becomes. You can pause your video player here. This breadth signal, pretty reliable. Near major lows shown on your screen. We just don't have it yet. 2002, 2008, 2011, 2015, 2016. All of them divergences on the retest, not the case in the present day. Pause your video player here. This is a weekly chart. Ideal buy point here, ideal buy point here. We don't look anything like that as of Thursday's close, nor Friday's close. This is the 30-week moving average shown in blue. Talked about the 2008 case in the past. RSI closed well below 59 on Friday at 49, and we closed below a downward sloping 50-day moving average in blue. This is what the close looked like. Historically, your drawdowns in the stock market tend to get a lot worse if you're moving into a recession. Typically, labor is the last thing to fall, starting to see some cracks. Given Powell's language this week, the probability of a deeper recession higher today than it was on Tuesday. And if the odds are increasing relative to a recession, then history tells us, as we've covered it in the past, that the odds are increasing that the S&P 500 could trade as low as 3,000-ish or 2,800-ish. S&P 500 was down 10% or more at the end of August this year. This is the average and median additional drawdown in the historical cases, right around 3,200 hypothetically. The inverse breadth thrust here that we covered in June, average and median additional drawdowns after that signal historically, again, down around 3,000, not a forecast in any shape, form, or fashion. Very, very difficult year, extremely difficult year if you read this. Speaks to the probability of avoiding a recession relative to the probability of potentially going into a significant recession. Talked about the clouds in detail last week. You can go back and review that video. You really don't want the present day to look like this period or this period. Last week we said the S&P 500 was batting 5 for 5 on the bearish boxes. Still batting 5 for 5 as of Friday's close. Also still batting 0 for 5 relative to the boxes that we could check at the major lows after the 1973-74 bear market, the dot-com bust bear market, the financial crisis bear market, etc. We don't have any of it as of Friday's close. Some tweets relative to Friday's big push higher counter trend move. Covered the 1962 case last week numerically. In the 1962 case, relative to where we were last week, the trend improved rapidly. We were weaker last week at a similar point. We're basically the same, 7.16% this Friday. Looks nothing like this. Looks nothing like a strong trend at this point. And that was when the S&P was up 63 points. It closed up closer to 50. Trend has a lot of work to do if it wants to claw its way back to this 1962 analogy. It may happen. It just hasn't happened yet. If the Fed was about to pivot and inflation was about to plummet, do we really think this chart would look like this as of Friday's close? Shows a strong weekly trend in interest rates. Interest rates moving higher. Last week this looked concerning for the bulls. It looks worse as of Friday's close. NASDAQ looked concerning last week. It was down big this week. Same can be said for the NYSE, down this week. Small caps, concerning last week, down this week. It's hard to improve on a chart like this when price falls on a weekly basis. Last week we could check all the bearish boxes, none of the bullish boxes. That's still the case today. You want to keep an open mind about the possibility of a counter-trend rally. Dollar looked extended last week, had a weak session on Friday. Amazon looked terrible last week. It got hammered this week. You can go back and see the weekly performance here. Covered the concerns for Google last week. It looks worse this week. NYSE at the close on Friday. Doesn't look good here. S&P 500 equal weight that's been outperforming. It's one of your strongest indices. Dropped below the red line. Here's what it could potentially mean. We covered it last week. All of these as of Friday's close, November 4th. Can things improve? Absolutely, positively, yes. They could start improving rapidly Monday, but they haven't improved yet. Microsoft concerning last week, down this week. If interest rates were about to peak and inflation was about to peak, common sense says it would be a good time to lock down yields and buy bonds. Weekly IEI. Can't check any bullish boxes, down. Daily IEI. Can't check any bullish boxes. Leaves the door open to the possibility of a counter-trend rally. Keep an open mind. Think of this question, and this question. If the answers are going to be yes at some point, the chart of IEF needs to improve. It needs to look better than it does in the present day. JNK weekly, can't check any bullish boxes. The daily has rallied back to the cloud here, which is potential resistance. Keeping an open mind, went to look and see if there was a 913 on the daily chart of JNK or junk bonds. There was a 913 in June. Don't have anything like that today. This 9 down here negates this count here. And we recently had a TDST qualified bearish break. It's not encouraging. It basically says the odds have improved, that the trend on the daily chart for JNK has flipped from up to down, and that the odds say that we would go all the way out to a 913 count in this direction. That would take at least 10 trading days or 2 weeks, best case scenario. Doesn't predict anything, just speaks to probabilities. TLT weekly as of Friday's close, batting 5 for 5, bearish weekly cloud. LQD concerning last week, down this week. VTV concerning last week, down this week, difficult to improve. What does growth divided by value, not being able to check any of the 5 bullish boxes, say about the questions at the beginning of the video? It says a lot. You may remember a few weeks back we covered this chart here, 10-year yield relative to the S&P 500. What did it look like when the market bottomed in 1974? It didn't look anything like this. This is as of Friday's close. I think if you look at things objectively here, these are the most important bullet points on the screen, and they're underneath the bearish heading. All of this still applies. The long-term concerns, things that we've been concerned about, we still have a rolling overlook. Regardless of what we've said in this video or shown, this is really, really important. The most important destinations for investors. Destination number 1, the terminal rate or peak in interest rates for this Fed cycle. The Fed chairman told you we're not there yet. Destination 2, the bear market bottom. Why is that relevant? Let's say hypothetically the market goes down into this area here or down into this area here. All of that quite possible relative to history. If we have a sharp counter trend rally hypothetically into year end, but we eventually go down to 3,400, 3,200, 3,000, 2,800 hypothetically, this is what matters. It's the final destination that matters. As always, making no assumptions on that topic. Covered it in detail in the past, and based on the developments this week, history still leans toward a bottom coming somewhere in the December window of this year, or sometime in Q1, early Q2 next year, with the S&P finding a closing low, final low between 2,800 and 3,400. That's based on history, no opinions there. Based on some other factors, maybe the 3,000 to 3,200, especially 3,200 seems like a logical level. None of that represents a forecast. We just want to understand within the context of history what's possible. If you go back and read the original Wall Street Journal article, the text appears in this video, the Fed basically has a stated objective of keeping credit conditions tight and hence asset prices either low or even lower. Remember, the financial markets are the mechanism through which the Fed implements its policies. Risk on makes it difficult for them. Powell could not have been clearer this week. As noted earlier, Fed will stay very unfriendly until the pivot. Why? They don't want inflation expectations to become unanchored. Given what's already transpired, it's very possible that non-farm payrolls will plummet soon. It's also possible that inflation could plummet soon. Could. When the Fed sees what it wants to see or sees too much of what it doesn't want to see, it will adjust as needed. Swift and violent. All four of the questions are against the major low being in place right now. Counter-trend moves, 100% normal and to be expected. When both of the destinations are reached, history says significant opportunity most likely awaits on the other side. Thus, we don't want to get stuck on a story, including the story told in this week's video. If the data drifts from the base case, and we're discussing the base case now, we need a new base case. Have to stay aligned with the data. Trade the chart in front of you. Read the Fed transcript in front of you. It's a lot to think about. We all know the only way it's going to work is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.